for tuning into Talking Point. I'm your host Neeraj Shah, and it's been quite an eventful last couple of months, to say the least. Just that in the session yesterday, there is a whiff of a positive development on the geopolitical front. Now, can one extend that to a continued positivity for the near term? That's one question. And more importantly, what should investor behavior be? What should investors be looking at in the current scenario, considering that the world in April will look materially different from how the world was looking start of January? Pramod Gubbi, founder at Marcellus Investment Management, joins us right now on the show with some of those thoughts, maybe. Pramod, great having you. Thanks for joining in. Hope all is safe.
Yes, thank you. Thanks for having me, Neeraj. Always great to be back on your show. Yes, all is safe by God's grace. Thank you for asking.
Yeah, that's what works beautifully that way. So Pramod, first a little bit of near term, then a little bit of medium term, and then a little bit of behavioral. That's how I want to kind of divide this conversation up today. The near term, too early to say, but a bit of a reconciliatory or a patching up kind of statement. The first of those statements coming in. I'm sure there'll be many more needed. But my question to you is, have things having run the way they have, commodities having run up the way they have, and then the subsequent slight bit of a cool off that we've seen even before yesterday's statements came in. What's your sense about what the near term holds in store for supply chains, for commodities, and the impact that they have? I know it's difficult to comprehend, but how would you approach this whole piece?
Yeah, well, look, absolutely right. It's not just difficult. I'm not even qualified. I'm not a geopolitics expert to figure these things out. But as a layman, you can see that, look, the world is so integrated now. I don't think any country can afford this situation to persist for too long. Even the two countries and the rest of the world, might have imposed sanctions. I think the rest of the world is suffering more from those sanctions than the country on which it has been imposed. Having said that, look, not everything in the world is rational. So, which is why there are wars. Otherwise, there wouldn't be wars in the first place. Having said that, I think given that there is some sort of reconciliation, which is reflective of the fact that we can't afford this war for far too long by both countries, you can expect some sort of an abatement in the geopolitical situation. Hopefully, better sense prevails on both parties, and we have that. And given a lot of the weakness in the markets and the threats have been coming from the inflationary pressures on economies, particularly a country like ours, which is an importer of commodities, if we remove this supply shock, there should be an abatement of commodity prices, which should augur well for consumption, economic growth, and hopefully corporate earnings, and therefore stock prices as well. So fingers crossed that sort of a situation will emerge. But remember, inflation wasn't entirely brought on by this war. Inflationary pressures did exist even through the last year. And that's because we also had another supply shock before that. Pandemic was because of the supply chains breaking. Add to it, the Western economies, Western governments and central banks created an unprecedented stimulus, which created demand pressures. So this inflation has multiple drivers to it. We had two supply shocks and a massive stimulus. So to that extent, the way the West will go about addressing the inflationary pressures will be interesting to see. There's furthermore complication in the fact that Western governments' debt to GDP ratios have been at unprecedented levels. So to that extent, even the West cannot afford too much of a monetary tightening to resolve the inflationary situation. So literally, they and all of us have to pray that once the supply shocks are withdrawn, we will see an abatement in inflation, and therefore you don't need that sort of monetary tightening again. And we're back to some semblance of normalcy. So that should be the base case situation. I think the pandemic is behind us, except for some spurts in East Asia. The rest of the world seems to be coming back to normalcy in terms of human activity, economic activity. If we have a resolution to the war, then we'll just have to deal with some monetary tightening. I don't expect too much of a monetary tightening, and therefore maybe if you take a 12 to 18-month view, we should be looking at a fairly normal in the new circumstance. These days, nothing is normal. I don't think we've had a normal period for almost 6 years now. But relatively normal circumstance, so that we can work purely based on fundamentals and put money to work.
So would it be safe to assume, Pramod, that if things shape up as per plan, as per what you're saying they could, then you are a lot more constructive on equities in general than maybe what most of the street would be? Or forget the relativity. I'm just asking in absolute terms. Are you a lot more constructive?
I mean, look, my view will be biased. That's all we do. We only do equities. We are an equity fund manager. So, but even otherwise, I think even if you assume the base case as an inflationary situation, equities perhaps are the best asset class to beat it. Of course, commodities are there, but I don't think there have been allocators recommending too strong position in commodities. It's at best a trading play, a transient play, but long-term wealth creation to beat inflationary forces has to be through equities. So all the more reason you need to be positioned in equities. And at the same time, if you've seen some sort of weakness in stock prices based on these temporary forces with no structural change to fundamentals of the companies that you're investing in, I would say this is as good an opportunity to buy, except we won't be able to time ourselves to perfection in terms of whether this is the bottom. For all you know, we could see another 10% downside from here. But to the extent that we all accept that we can't time ourselves to perfection, if stock prices have fallen without any commensurate deterioration in fundamentals, I would say this is a good time to put money to work.
Okay. Now I'll talk a bit about how are you approach these current times from a mental perspective. But before that, the here and now, Pramod. When you say the no inherent change or no big change to the inherent fundamentals, that would probably be true for select pockets which don't get impacted too much by the commodity price inflation. And a bunch of pockets actually do, right? So my question to you is, have the bets that you place, have the themes that you choose, have they changed materially from what they would have been at the start of 2022 to what they are right now?
Not really. I don't think we can operate like that. Remember, like I said right at the outset, we are not experts on these situations. We are not experts on geopolitics, and therefore we have no view on how long this commodity price inflation will remain. So therefore, to make bets based on something we don't know will be a bit unfair on our clients. And we've always articulated our philosophy as we assume the worst is likely to happen. How can we build or position ourselves with a portfolio of companies which deliver even modest outcomes in the worst of situations? And of course, if the external environment turns favorable, you will ride that. So effectively, what we're doing is minimize the downside and retain the upside. May not be the upside which you would have earned if you had, say, invested in energy or commodities in the last 6 to 12 months. We're happy to forego that sort of an upside, but that's coming from an honest admission that, look, we have no ability to predict these things, and therefore our view remains the fact that, look, let's assume that the worst is going to happen. If commodity price inflation is going to stay elevated, what sort of companies can give us that protection? Naturally speaking, you would see that companies which have extremely strong pricing power, which have almost minimal, I don't think zero price elasticity exists, but minimal price elasticity, which means that I can take price hikes without killing consumer demand. And secondly, in terms of having a sustainable competitive advantage where you can afford to take price hikes without losing market share. If you can identify such companies, and such companies do exist. I mean, it's not like they can take price hikes overnight. There is a lag, of course. You don't want to take price hikes overnight that you create some sort of a shock amongst consumers. But if you can phase it out over a couple of quarters, maybe you take a couple of quarters of hits in terms of margin compression, But eventually, when the price hikes happen, you will regain your margins. And more importantly, you have to remember that raw material price increases affects the entire industry, right? And therefore, if you are the market leader with perhaps the strongest competitive advantage and a very strong balance sheet, as compared to your weaker competitors who can't afford to take even 2 quarters of margin compression, you're actually likely to benefit at the end of the crisis, because at the end of the crisis, you see that there are fewer competitors left. So one, you regain your margins, and second, you gain market share. And we've seen this. This is not the first time commodity prices have rallied, right? So you look back at the last 10, 20, 30 years, you've seen this play out time and again. Commodity price inflation, much like other crises, are drivers of consolidation in industries. After the crisis, there are fewer companies left in every industry. So in a very perverse way, this is actually beneficial for these sorts of companies in the long run. It actually expands intrinsic value.
So let me ask you, where within your teams has this resolve gotten strengthened that they might actually gain disproportionately at the end when the dust settles down? Or have the teams consistently remained the same, or has there been some tinkering? Just trying to figure that out.
No, like I said, ours is entirely bottom-up strategy. There are three things for in companies, as you know. One is the governance has to be completely clean and solid.
Sure.
Second, we'll need some resilience in the business model, as demonstrated by the capital allocation over the years. And third is sustainable competitive advantages, so that companies attract, especially successful companies, attract more competition all the time. So you need to be defensive against that. If those three criteria are met, it doesn't matter what theme or what macro theme it plays into, what sector it comes from. It so happens that we do find companies in sectors where brand and distribution are a big source of competitive advantage. Alongside that, supply chain efficiencies using technology and big data. So given these three are found to be more common and more sustainable sources of competitive advantages, we find companies or our portfolio skewed towards more consumer-driven companies, where you're catering to a whole host of consumers, where your appeal needs to be driven by a very strong underlying brand. And to be able to reach these consumers, you need to have distribution, and neither of these two can be built overnight. Plus, at the same time, if you are a consumer of raw materials as inputs, you will need significant efficiencies in terms of procurement and sourcing, supply chain, etc. So those are common traits of companies in our portfolio. These span across building materials, as you know, say an Asian Paints, Berger Paints, Pidilite, or consumer discretionary like Titan and Page Industries, or even B2C or retail-focused financials like Bajaj Finance, HDFC Bank, or a few healthcare companies like Dr. Lal's and Divi's Lab. So more often we find sources of competitive advantages in these three baskets, and that's how the portfolio shapes up. Otherwise, we don't make a call that, look, the next years we're going to have the best capex cycle that India has seen, which are the best winners of a capex cycle, let's construct that portfolio. We don't do that because
I was about to ask you that.
Look, it's been 7 years we've been waiting for a capex cycle. I know lots of investors have been building portfolios on the basis of that and still waiting for it. I think we were about to see one had this shock not come through, because we are finally reaching a stage where one, demand is recovering pretty strongly. So companies catering to that demand are seeing utilizations go up where there is need to expand capacity. At the same time, balance sheets have been deleveraged significantly. Cost of capital still is fairly attractive. So we have all the makings of a capex cycle, but then you couldn't have factored in Ukraine. So, which is our point, that look, we won't be able to find these sort of Goldilocks sort of predictable scenarios. We are prepared for the worst, and if things work out, we'll also benefit.
Okay, so since the capex cycle debate is out of the way, I'm tempted to ask you: did you get? I know you mentioned that you don't time cycles, etc., but metals seem to be an obvious one to a lot of people. Did you guys get tempted to play? Did you play it? Are you still owning some commodity companies, or are you staying away from them completely?
So look, again, we don't have anything against metal companies or commodity companies. We look for those three factors. Where commodity companies sort of generally fail is the resilience aspect, and also competitive advantage in some ways is not that easy to build in commodities. That by definition they are commodities, right? So it's not like there's any differentiation in the product itself. But of course, certain companies can build cost advantages, supply chain advantages, and build competitive advantage. But the resilience is not there. So there will be worst of macroeconomic environments. Commodities are increasingly in a world where the economy is financialized. Commodities are subject to even more amplified cycles in terms of ups and downs. And therefore, that downside minimization I talked about as being central to our philosophy doesn't allow us to invest in metals and commodities. We're happy to lose out on the sort of super rally that we've seen over the last few months in exchange for long-term stability and consistency.
Okay. One question on flows and then one question on behavioral aspects, or a couple of questions out there on the behavioral aspect. One question on flows, Pramod. In your earlier avatar, of course, you used to handle sales and were probably in day-to-day touch, now maybe no longer so. But what's your view on this incessant FI outflow that we've seen from India? And any guesses? And I'm using the term guess simply because I don't want you to make a prediction only to find it wrong. So therefore, I'm because it's very much possible that it will happen that way. But what's your sense or what's your guess on why have flows behaved the way they have? And can they turn around at some point of time? And what could lead to that?
Look, first of all, the FI is a bit of a misnomer in some ways, because there are several different types of FIs who have different motivations, different drivers of flows. So to bracket all of them in one basket may not be necessary. And it's not hard to see what's happening to some pockets as well, right? One of the pockets is simply driven by cost of capital arbitrage. If cost of capital is going up in the West, naturally the marginal flows will shift back to the West. It's only natural. So to that extent, one basket is reacting to interest rate hikes and the fact that the Federal Reserve has stopped buying U.S. treasuries and mortgage-backed securities. There is appetite there. Second is also the broader effect of ETFs, and within that, say, an emerging market ETF, right? An emerging market ETF, India is a beneficiary, as well as India gets affected by flows into emerging market ETFs either way. And the last couple of years, or perhaps 12 to 18 months, China, which has been the biggest weight in the EM ETFs, has had issues. So therefore, if people reacting to China and pull out of EM ETFs, naturally some money will go out of India as well, which has nothing to do with India, but that affects. And these two drivers have nothing to do with a foreigner's view on how India is attractive as an investment destination or not. Then you have the whole host of fundamental driven FIs who are basing their decision on attractiveness of a certain economy or a country or a market. Those, I reckon, I'm not privy, like I said, in the sell side, I would have had several more conversations with investors. On the buy side, just speaking to friends in the industry, I think if at all, India is becoming more and more attractive for those investors. It's just waiting for the raw material price pressures to get off, but otherwise, fundamentally, demand-wise, we are insulated globally. We have a large domestic market. I don't know. I don't believe in deglobalization, but if people think that the rest of the world is sort of getting isolated again, India is rightly positioned because we have an entire domestic consumption, which is attractive for companies in India, and therefore, I would think, for the fundamental long-term driven FI, India is still very attractive. So maybe once the inflationary pressures abate, once there is clarity on monetary policy from the Fed, like I said, my base case is I don't think there'll be too many interest rate increases. Maybe we'll see a few more. To that extent, if inflation remains high in the West with not much of interest rate hikes, then you might see more capital coming into more sensible economies like India. Our debt to GDP is in far greater shape than America. So hopefully that will pan out. Once this war situation abates.
Okay. One aspect of investing underappreciated would be the what an investor may not necessarily always believe in or realize at the outset, the stability of the performance of individual portfolios or for investment portfolios, as the case may be. My question to you, Pramod, is that are you guys striving for that stability in your performance to keep your set of investors happy? Or do you genuinely believe that's the way to go about doing investing any which ways? Because investing is not necessarily always only about giving a top dollar return as opposed to giving a stability.
Absolutely. I think we've realized it the hard way in some ways. I think now there are enough studies to show how investor returns lag fund returns by as much as 5% over the long run, which means that the fund manager might have done a great job, but because the investor in the fund has chosen to second guess the fund manager's fund's performance and hence time their entry and exit into the fund, they have ended up making exactly the wrong decisions on the entry and exit, and therefore their eventual returns have been significantly lower than the fund manager's returns. And this now we've realized, as say Daniel Kahneman showed in his seminal Nobel Prize winning work, or several other people have pointed out, it is no fault of any investor. It simply boils down to how the human brain is wired. The human brain cannot handle volatility, right? Volatility drives you to make irrational decisions based on emotions, which is like in March 2020, when the market is down 30%, you can't blame anyone to sort of throw in the towel and press the sell button, right? By doing that, what have you done? One is you've converted your paper losses on the portfolio statement into real losses. You've crystallized the losses. And second, you've deprived yourself an opportunity to play the recovery that ensued. I don't think anybody knew that the recovery will be as sharp. But the problem is, once you've exited, you try and keep justifying that reason that, look, it doesn't make sense. Obviously, it didn't make sense because the next 6 months, there was a proper lockdown in the economy. No sensible person would have thought this is a great time to invest, but yet that's how the markets behave. And therefore, to avoid investors going through this emotional turmoil of ups and downs in their portfolio and giving them the best chance of making long-term returns, which is only through staying invested, not trying to time your entry and exit. To help people stay invested, you need to deliver a consistent performance. And to aim for a consistent performance, it is quite possible that you let go of some outlier or long tail return events, like the last 12 months, for example, which has been in the case of commodities. We want to aim at a very narrow set of outcomes for investors, where you are letting go of some upside in exchange for cutting down that downside. And that in turn helps investors to stay invested and therefore benefit from long-term compounding. That's a behavioral lesson we learned. It's easy to say that, look, this is the best time to invest. I don't think many people have the courage, because the best time to invest is also accompanied by lots of negative news flow, and it's not easy to muster the courage. So, which is why we take the safer view: stay invested. If you can top up during these times, it's fantastic. But as long as you don't make the cardinal mistake of exiting during such times, you'll eventually benefit from long-term compounding.
Yeah, lesson often repeated, but not often performed, if I can put it that way. But Pramod, this is great talking to you today. Thank you so much for sharing the time and giving us some idea of how you guys are thinking.
Thank you. Thanks for having me on the show. It's great to be here again.
Well, always great having you. Viewers, thanks for tuning in.